Welcome to this edition of Dynamic Market Updates, a deeper look at what's happening beneath the surface of markets and why it matters. Over the weekend, the US and Israel launched military strikes against Iran under Operation Epic Fury. The situation is serious, and if you're wondering what it means for your portfolio, that's exactly what we're here to talk about. Markets moved fast on Monday. Brent crude surged toward $85. The US dollar strengthened toward 99 on the DXY. And here's the one that surprises most people. Treasury yields went up, not down. The 10-year rose to 4.07%. In a typical crisis, investors rush into bonds and yields fall. Not this time. The market is more worried about energy-driven inflation than recession. That distinction matters, and it's exactly why a traditional 60-40 portfolio is not built for a moment like this. Meanwhile, US equities actually held up. The S&P 500 was essentially flat, and the Nasdaq gained slightly, driven by a rotation into energy, defense, and high-margin software. Europe and Asia down nearly 2% because they're net energy importers. At over $80 for oil, that's a direct hit to their corporate margins. Here's what's important to remember. This didn't come out of nowhere. Whether it's Iran's 2019 drone strikes on Saudi oil infrastructure, Hamas's October 2023 attack, Israel's 12-day campaign against Iran last summer, failed nuclear negotiations, and a U.S. military buildup in the region that was visible for weeks. The targeting of Iran's senior leadership is a significant escalation, but markets over time have navigated every major geopolitical shock in history. This chart tells a story that most people miss when they hear about conflict in the Middle East. Look at who's actually producing oil and gas in the world today. The U.S. is at the top. 13.7 million barrels per day of crude oil and over 103 billion cubic feet of natural gas daily. Saudi Arabia and Russia are both around 10 million barrels, and Iran, they're sitting at 3.1 million barrels, toward the right side of this chart, well behind the leaders. Now, Iran still matters. The Strait of Hormuz runs through their backyard, and roughly one-third of all seaborne oil exports pass through it. That geographic leverage is real, and the threat of disruption is moving prices. Look at this chart. Every one of those lines represents the S&P 500 starting from the moment a major conflict began. And yes, the message is encouraging. Over 5 and 10 years, the market was higher in most cases. But look at the path to get there. Those lines are not smooth. They gyrate. They drop sharply, recover, drop again. Also, a number of the periods show very low growth, even over a 10-year period, some not even keeping up with inflation. This is exactly why we build multi-dimensional portfolios. Not because we don't believe in the long-term direction of markets, we do, but because the journey matters. Adding non-correlated strategies like global macro, trend following, arbitrage, and others, you build a portfolio with the ability to generate a smoother ride with fewer gut-wrenching drops, helping one to stay invested long enough to capture the recovery. The goal isn't to predict the future, it's to prepare for it, regardless of what happens. We've seen this before. The headlines are loud, the uncertainty is real, but markets are resilient, and disciplined investors who stay the course have always been rewarded. What's happening right now in Iran is serious. But it is not a reason to abandon a strategy built for exactly these conditions. Stay focused on the long term. Trust the process. And if you have questions about how your portfolio is positioned for what's ahead, reach out. Until next time, take care everyone and make smart, logical, and fact-based financial decisions.